Frequently throughout this chapter, we're going to have to evaluate certain ratios, and to evaluate something we need a benchmark, which is basically something to compare it to. So looking at the reports, these are from 2013-14 for Myer, Supercheap Auto and The Reject Shop. We can see three companies of varying size. So we take the revenue for Myer is bigger than Super Retail and much bigger than The Reject Shop. Its gross profit is quite a bit bigger as well, about 4 times bigger than The Reject Shop. Its net profit is the best part of 8 times bigger than The Reject Shop. Total assets, it's a much bigger company in terms of its resources than both of those. And the owner's equity again is much bigger. Now they're just numbers. What we've been learning or looking at for their financial reports in chapter 20 and 22 is, can we actually derive any meaning from them? Can we analyze and interpret them? So to do that, we need to be able to analyze each number compared to another number. And we haven't got those skills just yet, but we will learn them. But looking at that in the real world, you would say, looking at Myer, its figures, it's clearly got the best set of figures. So people on the share market should be paying more for that share. That's actually not the case. At the time that these figures were taken, the share price was actually the dearest for The Reject Shop. And it's about 4 times bigger, or a little bit under, 4 times bigger than Myer. And that's quite interesting because given the discrepancy in a lot of numbers, so net profit's an important number and The Reject Shops is much smaller, yet that clearly hasn't flowed through to the share price, and that's all to do with analysis and interpretation. That's because we're comparing it to different things and different benchmarks, and that's what we're going to learn. So some of the things that we can compare them to are the analytical ratios. That's where it compares two items that have a particular relationship to each other. And that's what, for the rest of the chapter, we're going to go through each of the indicators there. So we can either call them an indicator or a ratio. And we can see each one measures a certain thing. So some ratios measure profitability, some measure efficiency, some measure liquidity, and one measures stability. Now what those words mean is what we'll learn as we go through the chapter. Say a business had the following analytical ratios: gross profit margin of 45%, quick asset of 6.18, return on investment of 14, and asset turnover of 3.4. Those numbers are useless unless you can actually interpret them, and better yet, have something to compare them to. So to determine whether we perform well, we need to compare any ratio with a benchmark. So whenever we get asked to compare something to a benchmark, we're going to be looking for things like, can we compare it to the trend? What did we achieve on that ratio last year? Our gross profit was 52% this year. What was it last year? Was it higher or lower? We can also compare it to an industry average. What did similar businesses in our industry achieve? Are we higher or lower than the average? We can also look at our budgeted expectation. What did we do? What did we expect to do? And how did we go compared to that figure? And lastly, for a ratio called return on investment, we can look at, well, what sort of return can I get on alternative investments? I don't have to put my money into a business and start my own. I could go and invest in someone else's business, and on the share market, I could buy property, gold, oil, any sort of asset. I don't have to give it to my own business. So I'd like to know the percentage of return for other investments as well.